Hi everyone, my name is Alex. I'm the founder of Nauma, a personal finance platform that helps people in tech make better financial decisions and save millions of dollars. People create their financial plans, organize their investments, and do tax planning using our platform. Today we will talk about saving for college and how you can structure your college fund using our tool. One of the biggest problems people have is understanding how much they need to save total and how to use tax advantage accounts such as 529. Oversaving in 529 is actually a very common problem. Yes, you can convert up to $35,000 in 529 to a Roth IRA account after 15 years. You also can use the funds there for your own education or grandchildren, but having unused funds in 529 is really inconvenient. Today, I will show you how you can reduce the chances of both oversaving and undersaving when creating a college fund for your kids. And we will consider an example of the family living in the Bay Area. They have two kids, Kevin, who is already 13 years old, and Steph, she is 10 years old. We will be saving and creating fund to save for college for Steph today in this example. So she's 10 years old, and she will go into the college in 8 years. The family already have 529 accounts opened, and for both kids they saved $250,000, and we'll use these accounts in our modeling today. So when we start, we first try to understand the expenses associated with college and the school. We already here created a financial projection, so let me switch to the default one scenario. And you see there are different life events in this projection. And there's already an event, college for Steph, which is created, and it shows expenses and how they will change over time. The family expects that they will have expenses while Steph is in middle school, high school, she's currently in elementary school till the end of this year, and when she goes to college. The way we decide these expenses is there is a separate Google spreadsheet that we use when we work with our clients. And let me just show it really quick here. We have a detailed breakdown for the expenses for each stage of the family. So there is a college, grade school, preschool, and we normally work with the families and try to understand what their preferences, and so we could come up with estimates. And then here there's family of three, for instance. We look at how it's going, combined expenses for all three kids are going to look like. So this is very, very useful. Then we take that data and move it into the financial projections. And as you can see here, it's already adjusted for inflation. So if it says for college $71.5 thousand a year, which assumes either private school, private college, or out of state, then actual expenses are actually higher because of the inflation. So we take that into the account. So once financial projection is done and we understand our expenses, then we go into the model 5 where we set the financial goals. So we click start there when first we choose a projection that we will be using to create our financial goals. And in this case, we will be using the default scenario. So we'll select that. Oh, actually, let me use a different one. So I will use by winter house, just because there's no data created there. So when you first open that model, it will ask you about your planning style, your preference. There are two options. There's a basic one, which is on the left, an advanced one. Basic says that we put everything together. We have one portfolio for all our financial goals. It's easy, but it's less tax efficient, and it makes it harder to optimize your risk management and tax planning. On the right, we have advanced one when we separate the financial goals and we create the portfolio for each goal separately. That allows us to customize the portfolios and do better tax planning, including 529, using 529 accounts. So because we are saving for college and we plan to use tax advantage accounts, we will use the advanced one. So when I click first time, because there are no financial goals created yet, it will ask me to create my first financial goal. And we will name it, because we are saving for college, right? We're creating a fund there. We will name it school and college for Steph. All right, we click create. And now on this screen, we are selecting life events that will be included into this financial goal. What we are trying to achieve here is to estimate the annual cash flow deficit that we will need to cover from the savings. So for instance, if I click on this life event, College for Steph, you see this, it added this deficit. So it's annual expected deficit that we will have. And if you look back what we did in the previous screens, you will notice that this curve is very similar to the expenses that we had in financial projections, right? So when Steph is in elementary, middle school, and high school, expenses are relatively small, but then she goes to the college, it went up. So this is the deficit that we are trying to cover by savings, and different families actually have different approach here. Some families separate school and college expenses. They have a different life events and even different goals. Other families, if they have a few kids, they actually put everything together. So it's your preference how you organize that. In this demo account, we separated it by kids, but we kept school and college expenses together. That's why you can see that here. All right, so we decided our life events that will be included into this financial goal. Let's click continue. And now we are setting up a fund, right? So on the right, we see the fund balance. And of course, it goes under the water because we don't have any money initially in the fund, and we are not contributing into that fund. So, but we are taking money from these funds. So obviously, it goes below the zero immediately, right? So we will start now deciding how we are going to fill this money with this fund with the money. And here on the bottom, we have initial fund allocation, and we have three types of accounts, right? Taxable, tax deferred, and tax free accounts. So taxation is very important. So we separate these things when we decide to use the existing assets that the family has to create a fund. So let's first start and take taxable accounts, for instance, right? We have $1.6 million in a Vanguard brokerage account, which is not used by any goal. So we can actually use all of that. So let's see what will happen, right? So we will click, a few things have changed. So first, you notice that there's these black bars that were added. It's because we estimate taxes now, right? So the system understands that it's a taxable account. It knows its cost basis. It knows how it's going to grow, and it automatically calculates tax provisioning for this account. On the right, we see that now we are positive, but obviously we are over saving because at the end of the 2037, there will be like $2.7 million in that college fund. Obviously, we don't need so much money there, so we should reduce the amount that we put in there. So let's go and put something maybe 350. Let's click apply. And well, that was pretty accurate. So what it tells us is that if today the family will just take $355,000 from their current savings and separate that and say, this is for Steph, they will be done. They don't need to worry about that anymore. They just need to make sure that they take money as they planned and they properly manage that fund, right? So that means they don't gamble, they properly invest that. Here we use balanced portfolio, so you can see like what it means. In this case, it's not any specific portfolio that we provide. It's just total stock market, bond, ETF, and cash. These are three basic components. Of course, then later you can customize these things, and there is a custom portfolio that you can specify here if you want to, and with its own expected return and volatility, but we will get to that later. Also, you can increase the amount of risk and click apply in the portfolio if you would like to, but that's your decision. Now, the family has 529 accounts. So we are going to use, instead of this taxable Vanguard account, we will use their 529. And that's a Steph account. So we'll click and use all the money in it. And now we see that we don't have enough because the fund runs out of money eventually. So we need to add some contributions. And because the family is also has school expenses, they don't want to use 529 for that. So let's start contributing into some brokerage accounts. So you see that here we have all accounts that the family has, and we are not going to contribute into 529. So instead we will be contributing into, let's say, the same brokerage account because we haven't created a separate one. and annually we'll be putting $10,000. We have a choice whether we keep it constant $10,000, so maybe that will increase or decrease over time. So we'll say, let's just keep it as is, $10,000. And we will start today in July 2025. And we will do that for, let's say, 10 years until July or maybe August 2035, I'm sorry. So we'll click apply, and we see that now we see these contributions on the left, but it's still not enough. Okay, so let's increase these contributions, since let's say something may be $19,000. Click apply. All right, and now the system says that the fund looks good. We have a balanced plan, right? And this is aggressive portfolio. What if I would like to do maybe balanced portfolio instead? So we are a little bit out of money at the end. So maybe I would increase it to contributions to $20,000 a year. So to get it maybe to even 21, so that we don't have it, right? Okay, so I think that's fine. So, and everyone can pick their own number. So we have now a balanced plan, and we have a good understanding like what we need to do, in terms of contributions. We understand what our planned expenses are and how the fund balance will change over time. So this is good. Now, let's say if I don't want to use 529 accounts. So let's talk about like how these tax advanced accounts actually help us, right? And what we will do, let's go back. So here we used $128,000 in tax advanced accounts. So let's, again, going back to brokerage account and use that, click apply. So you see that now tax provisioning has been added, right? And now these contributions in $21,000 is not sufficient, right? We'll need to increase the amount of contributions. So let's see how much we need to increase. We'll do that maybe by $5,000. Okay, so that answers our question, right? So we increased our annual contributions by $5,000 because we don't want to use 529. We are going to do these contributions for 10 years. That means that using 529 account saves us $50,000 roughly, right? So now we can make a decision whether we would like to use a 529 account, because there are some scenarios when you don't need that, right? Or you don't want to use 529. All right, so I hope that, so then we can press continue. The next thing that we do is that we test this portfolio in a Monte Carlo simulation. And you can currently see that the success rate is 72%. That's a little bit on the low end. So usually when you run Monte Carlo simulation, you would like your success rate to be in the range between 70 and 95. So between 70 and 80, that would be for aggressive goals where you can take a lot of risk. 80, 90, that would be for moderate goals, and 90, 95 for conservative. You don't want your portfolio success rate be at 100%, because if it's 100%, that means that you are over saving or under investing. So here, actually, I would increase that amount. Let's say this is college, this is important for me. Let's increase these contributions maybe to $30,000 a year. So now we have 87. That's better. So that's a moderate goal. So we're taking a bit less risk in this case, and it looks better. So now we can save this goal. Okay, press save. And we got this goal on the list of our financial goals for the family. I hope that video was useful. You can try this process yourself. Go to nauma.ai and let me know if you have any questions. Thank you. See you in the next video.